How do you recommend categorizing owner's draw? Putting in or taking it out from the business, should that be considered liability account or an equity or asset account? A single member LLC and no payroll. Beautiful question. So in a single member, and you've given me all the information I need to answer it. Whoop! Love you, Naseem. I love when we speak the same language. So in a single member LLC, which appropriately to the owner doesn't have any payroll, an owner's draw is the phenomenon that happens when the business pays the owner. So when the owner says, it's time that I get paid, and the owner goes into the company's bank account and issues some kind of a payment, whether it's electronic or a check payment or a cash withdrawal, it is appropriate, as you say, to record it as owner's draw. And an owner's draw account is an equity account on the balance sheet. It does not show up on the profit and loss, otherwise known as an income statement. It does not show up as an expense account there. It's an equity account. So when you run a profit and loss statement for your single member LLC, you'll see the profit at the bottom, and that, long story short, is what you're going to pay income taxes on. Some of that money is already in your personal account as your personal income, and you're going to pay income taxes on that. But you don't see what the company pays you as an expense of the business. You see it as owner's draw. So now if you then also put money into the business, so here's where things get cool for tax purposes. If you put your money into the business to help provide some liquidity for investments in a social media marketing campaign, you show that contribution to the single member LLC either as an equity contribution or a debt contribution. If you, it's typically simpler to show it as an equity contribution, then you don't have to worry about interest and accruing interest or paying back interest. If that's something that you want to do, then draft up an informal loan document saying I'm loaning the money, this amount of money to the company, and you're going to record it as a liability. Most people do it as equity. It's a lot simpler. Now here's the cool thing for tax purposes. If you have given money to your company, put that money in the company's bank account, and then later on you decide, hey, it's time for me to get some money from my business. It is more tax advantaged to you to record that payback as a reduction of that equity that you put in. So let's say there's not an owner's draw account, but let's say there's another equity account called owner investments or owner contributions. The company paying you back is a reduction of that equity. It's a reduction of that contribution. Use that account instead, and that money is tax-free to you. It's called return of capital. Vocabulary! Vocabulary, did you get that? When the company pays you money back for what you've put in as an equity contribution, it is called a return of capital, and it is tax-free. So if you see fit that your company has enough cash on hand to pay you to give you money, call it a return of capital and debit your equity owner contribution account, and don't call it owner draw. Does this also apply to sole proprietorships, DBA? Yes, it does. Great follow-up question, Stephanie. Exactly, it does. Because single member LLCs are taxed the exact same way as a sole proprietorship. In fact, they even use the same tax form. They only have to report income and expenses. They don't even have to show a balance sheet on their tax return. So yes, it applies to sole proprietorships, whether or not you have a separate tax ID for your business, or if you're using your social security number. If you have put money into the business and the business pays you back, it's much better to call it a tax-free return of capital than to call it any kind of salary.